She said I'm JC Morales. I was born and raised in Puerto Rico, but lived in Beacon Hill for the last 30 years, with the exception of 2010 when I was at Bank of New York, Mexico, president and CEO. CPA by training, started my career at PricewaterhouseCoopers, and then did 10 years in Wall Street at various large financial institutions in a CFO capacity, right? A lot of strategic finance, capital markets activity, buying and selling transactions. When we did the last big one, the $6.5 billion that was the acquisition of the Nuveen Investments by TIAA-CREF, I said, this is it for me. I want to move closer to home. At the time I was in New York, living in Boston, but working in New York, and started Surfside Capital with a few other guys, which now has about 12 consultants. And all we do is strategic finance and growth strategy for small businesses, right? We've been doing that for 8 years, and I absolutely love it. There's nothing that gives me more reward to see a business owner that's been intrinsically or attached to that business for years, all of a sudden goes to an exit or a sale and puts a little bit of retirement money in their pocket, you know? Okay, we're gonna start with an icebreaker. And if you see around the walls, we have this pages 1, 2, 3, 4, 5, and then Zoom participants will get a Zoom survey to form to complete, right? And what I would ask you to stand up, go around the room with your magic marker, read the questions, and if whatever answer suits you, just hit it. It could be anonymous. Could be anonymous.
So they can just check off.
Yeah, you can check it out. You don't have to put your name, right?
Okay. Yeah, just checking the box of your pen.
Yeah. And I'm gonna move us around quickly because I want to get to the Q&A, which is where this becomes fun.
Yes. Check it out. Yeah, this is actually one question. So what should you consider? Yeah. It's.
So this is just a check or not check?
Oh.
What do you think of those numbers?
Yeah, I got it. What's it?
Yeah. Just give me one. Right. Make sure
So
each of you
this
has
is
a
just
vote individually.
So, sorry,
Is
Ted?
it just a check?
Yes,
Yeah,
put a
okay,
check
yeah.
under one answer, under A, B, or C.
Okay.
Yeah.
One answer.
Yeah, that's the question.
Above all, to buy a future cash flow stream, right? So you can have a business that has a lot of sales, but is losing money. That business, unless it's like a technology company, like an Amazon lost millions and millions, but their top line was going like this, same with Uber, Airbnb, right? But for most businesses, if you don't have profits, it's gonna impact your valuation, right? So you gotta have profits, right? Or cash flows, right? That's why the second one is wrong, the last 3 years. Net earnings plus my equipment, that was close, right? You're getting close, right? Because that's what you own there at replacement value, plus your net earnings. You do have to add back your salary because when a business is buying you, they don't have to pay you salary, you're gonna get the value of the business, you're gone, right? So, and it's important, the last part of that statement, which is, because a few years of my business, right? I'm gonna repeat it. It's the last sentence, you don't see it here. It says my salary plus equipment plus a few years of my business, right? That few years of a business in the deal business is called your multiple. Okay? Your multiple. Some companies are worth 3 times their multiple. Some companies are worth 10 times their multiple. The higher your margin, you guys know what margin is? Margin is the bigger the cushion you have between revenues and expenses, right? If you have a company that sells widgets and it costs you $9 per widget and you sell them for 10, you have a 1%, 10% margin. But if you have a company that you're selling a widget for $10 and it's costing you $3, you have a 70% margin, right? Generally speaking, the higher the margin, the higher the multiple. Why? Because again, buyers are looking to buy future cash flows, right? Okay. We're going to get into this multiple discussion because you're going to say multiple of what? It's multiple, it's not multiple of that equation, it's multiple of something called EBITDA, and we're going to talk about EBITDA later, okay? All right, the next question was, what is my business is worth what? Most of you, I don't know, that we did that already. What's, you have the next one?
There it is, number 2.
How do you find how much your business is worth, all right? The options, by checking how much money your business you made last year. History is important, but what they're looking to buy is the future, right? The future, right?
Past performance is no
No indicative
indication
of future results, right? So if you got a business that is making, 20-30% margins in years 1, 2, and 3, but the margins are declining, the buyers will say, what's going on here? I want to see, I'm buying the future earnings stream, right? Option B, by looking at what your business, like yours, have been sold. Excellent answer. That is the right answer, right? So there are many ways of valuing your business. The most commonly used one is market comparables, right? When you're buying, has anyone ever sold a house, a personal house?
Just now.
Okay, when you talk to the broker and the broker say, well, how are we gonna price it? They say, oh, let's look at what other properties that have 3 bedrooms, 2 bathrooms in this neighborhood have sold for recently, the comps,
That
right?
has to be challenging if you're in a neighborhood that your business is unique.
100%. There are at least 12 methods of valuing a business. Discounted cash flows, book values, market value. This is just one method called market comparables, right? If you can get the market comps, which is actually quite easy to do for public companies that are worth billions of dollars, right? Let's just say that we had a soda maker, right? We could look at what are the multiples of Pepsi, Coca-Cola, and say, oh yeah, this business is trading at 716, right? In Wall Street, that's called the price to earnings, the PE, right? But we're not gonna get into that, right? Okay? Option C was by adding all the money that you cash registered. Nope, wrong answer. That has nothing to do with business value, it has to do with balance sheet health, right? The healthier your balance sheet, the higher the multiple too, right? If you have a business that has solid margins, but is burdened with debt, that's huge amount of debt, right? Or very little cash, right? You get a haircut on the discount, right? Because it's not gonna be a healthy balance sheet that the acquirer is gonna be inherited, okay? Speaks to the next answer, which is by seeing how much money you owe. Hugely important, right? Leverage in a company decreases its value. It's okay to have leverage, it's okay to have debt, but the more leverage you have, the more burden it puts in the profit and loss, and the more as a buyer we say, this could impact the profitability of the acquired business, right? So I always tell people, be very smart about your debt. There's a lot of bad debtors out there, hard money lenders. We are, even if they're not hard money lenders, we're now in the economic cycle at a point in which interest rates, particularly commercial interest rates for unsecured debt is like 12, 15%, right? Very high borrowing costs. When you take out that borrowing cost, you put on the balance sheet, that's fine. It affects the marketability of your business. It doesn't remove it, it just affects it, okay? Okay, next question. By the way, any questions so far? Ask away.
And folks online can put their questions in the chat and I will relay them to the presenter.
And JC, and if I use a technical term that you're not familiar with, which often happens when I speak, right? Say, hey, JC, what do you mean by that, right? Stop me, right? Because if you didn't get the term, probably a lot of people didn't get the term, right? Okay? The next question. When should you consider when predicting your business future earnings, right? Most of you answer how much money your business could earn later. That is correct, right? I think this is a little bit of a trick question. I would argue that all of these are correct, right?
Yeah, right.
Because where your business is located, if you are in an area that has declining population trends, that will have an impact on the valuation of your business, right? How much you have in stock? Well, if you have already committed the capital to buy stock, right? That is gonna be impacting, assuming there's demand for that product, your earnings in future years. So yeah, that could impact the value of the business, right? How much your business could earn later? Absolutely, that is the value of projection. You need to have a forward looking. A lot of people look at their bank account and their tax return once a year. Our clients, I train them to be hyper-focused on the projections. Financials are outcome of strategic decisions. You do not want to be driving your car looking at the rear view mirror. You want to look at the windshield, right? You have to be able to predict how do you think you're going to do in Q2, in Q3, in Q4. I speak in quarters because as a public company CFO, I have to tell my boss, the CEO, at the beginning of the quarter how much we want to make for the quarter. So I'm always thinking one quarter ahead. There are many ways to develop financial models and projection models that will allow us to understand where the business is looking like in the future, right? When you are in selling mode, it's hugely important because the buyer is going to want to use, they're going to look at your historical financials, but they're going to say immediately, show me your projections. How do you think we're going to do next year, right? And they develop their own valuation of the firm based on those assumptions, okay? Okay, next page. What is an uncommon method for valuing the small business? An uncommon method, right? Looking at what the business owns, I would say that's very common, right? Guessing future profits and making them less for each year. I think that is highly uncommon. Your profit's gonna go the other way, right? Checking out how much profit you get from what you sell, yeah, those are the margins, right? And multiplying how much money you make every year times your multiple. I think that makes sense, right? So obviously, future profits and estimating future profits and coming up with a credible investment thesis to be persuading that buyer that said this is a healthy business that you want to pay, right? You're not going to do that if you have declining profits in future years, right? And that holds true whether you own a pizza shop or a technology company or a car dealer or a hospital or a daycare center. It's the same theory, right? Okay. Okay, was that the last one?
No, one more.
One more. What do you add to your business value when selling it? The cost of your own personal stuff? No. The good reputation of your business? 100%, right? There is something that is not in the financials. It's called brand value, right? Your business as a brand, which is comprised by you and the name of the business. And if you have problems with your brand, it will impact the valuation. If a murder took place in your premises, right? If someone that works for you was caught with fraudulent activities, right? If there was an article in the Boston Globe saying that you were arrested as a sexual predator, right? The brand of the business and the principal are intrinsically attached. And when something bad happens to the brand, something bad happens to the value of the business. Okay? So you got to protect your brand, right? Other ways that brands get damaged is by litigation, right? Like this, you have 6 employees, you fire someone, they sue you for wrongful termination, they put it online, oh my God, what a bad employer. That impacts your brand, protect your brand, okay? Okay, any questions so far? You guys enjoy it? Am I connecting?
Yeah.
Okay, great.
I actually have a question.
Sure.
Results, is there a platform? I mean, how do you find out what other businesses like in a small business situation is work?
Sure, so for small business, there's something called Dun & Bradstreet, and there's a lot of in the internet right now. I don't care what your business is. What is your business?
To do a retail shop.
A retail shop. So you don't have to go to that level of size. You can find out comparables in the sector, in the industry, right? How many other retail shops that are selling? What are you selling?
Clothing.
Clothing, right? Apparel, right? Consumer goods, right? So you go, if you were to Google consumer goods multiples for small businesses, you get your answer. Generally speaking, what are they trading for? Most businesses that have median margins trade around 2 to 3 times EBITDA. We're going to talk about EBITDA, right? So if you have a business that's a little bit hurting, low margins, the balance sheet doesn't look that pretty, now you go a little bit lower, 1.5 to 2.5 times. If you have a business that is high growth, high margin, biotech, technology, those businesses could trade for 20, 30 times EBITDA, right? Really high value business. If you have businesses that are capital intensive, right? We have a client that owns a transportation company. They put 30 or 40 million dollars in revenue every year. They make 2 to 3 million in profit, not bad, right? But they have to buy buses all the time, right? The capital intensity of a business, the ability for the business to suck oxygen, capital oxygen out of the environment impacts your valuation, right? Whether if you have a capital light business, my consulting company, right? I only pay my employees and that's it. I don't have any capital expenses, right? Those have higher margin, higher valuation, okay? So understand the capital needs of your business. And just to answer your question, you don't need to be that identical to get a general idea, right? Okay? All right, any questions online?
No questions online yet, but if you're online, please do ask questions. We will make sure JC hears them.
All right. Okay, let's go through we have a small little presentation and then we have 2 live exercises, right? That's me. I've lost a little bit of weight since that, but that's me. Go back for a second. I want to say something about Surfside. We deal with small businesses that have at least $1 million in revenue, right? And a lot of our businesses started at $1 million are now having 20, 30, 40 million dollars because we help them through the growth journey, including capital raising transactions or sell transactions, right? Right now we're selling a company that has $5 million in assets, $500 million in assets and $5 million in revenues, right? And we're assisting that, the guy was just like you one day and said to me, I got cancer. And I don't have more than a couple of years to live. So we had to put a SWAT team to get this company ready for sale. And this is why we have discussions like this. Exits take time. You do not put yourself in a position that you are in a hurry, right? Because then you're gonna have to give away your business, right? Okay. In the deal business, the magic word is EBITDA, right? EBITDA multiples, right? Remember I talked about multiples? You're gonna take your earnings, right? And multiply by a number, 3, 4, 5, 6, 7. So you gotta know what your business EBITDA is, okay? EBITDA is a proxy for cash flows, operating cash flows, okay? It's a formula, right? You take your net income, right? EBITDA stands for earnings before interest, tax, depreciation, and amortization, okay? Earnings, the profit, before interest, tax, depreciation, and amortization, right? In the deal business, we take those components out. I'll take the easy ones out first. The last 2, depreciation and amortization, because they're non-cash.
Is your earnings before expenses?
No,
Is that your net?
no, this is my net income.
Net, you
Yeah,
mean
yeah,
salary
yeah.
that you take out of the
Yeah,
business?
yeah, yeah. So you take your earnings, right?
Yeah.
This is how much I made my profit, right? And I had an interest expense of 100,000. I add that back. Why? Because the buyer will assume some of that debt, right? Either on their own or to the deal business, right? Or the seller will retire after closing, right? Same thing with income taxes. There are multiple tax structures in multiple transactions, depending on what type of legal entity you have, which country you are, which state you are, right? So the buyer and the seller usually work together in structuring a deal that is tax advantageous to both, right? So we don't want taxes to get in the way of evaluating the true operating performance of the business as we take that out, right? So you take your net income and back out taxes, interest, depreciation, amortization, that's your EBITDA. That's your EBITDA number, right? You asked a good question. Is the owner's salary in there? Yes, it is. Okay, because once you calculate your EBITDA, there's things called EBITDA normalizations, right? Like discretionary pay that the owner was taking. I was paying for my kids' college fund. You take that out because the seller wants to tell the buyer, look, I make more money than this. I just put a lot of private expenses through it, right? So you normalize that stuff out. If you got a state grant, that was 1 year state grant, you gotta take that out. That's not recurring revenue, right? Those are called EBITDA normalizations, okay? But then you get to an EBITDA number, and then you have to figure out, okay, what is the appropriate multiple for that EBITDA numbers, right? And there's a lot of science and technical stuff that goes behind it. Which we're not gonna have time to get into today, right? But by far, the most pervasive valuation method is called discounted cash flow. So they project your EBITDA for the next 5 years. Discounted cash flows, and look, if we were to believe in these projections, your EBITDA multiple will be 3 or 4 times, right? There's actually an ugly spreadsheet that comes behind that, right? With terminal values, discount rates, and all these finance nerdy lingos that we're not gonna talk about today, right? But generally speaking, if you're dealing with a sophisticated buyer, sophisticated seller, you walk the quantitative analysis of how you go to your business value, the buyer will listen to it, right? That's very different than saying, I'm gonna sell my business, I think it's worth $300,000. Well, how do you come up with that number? Well, I just think it's worth $300. You gotta have some, go ahead, yeah.
Yeah, I got a question online.
Yeah.
Why plus, not minus? Taxes, interest, and depreciation are reducing the net income, question mark?
Yeah, because what the buyer is looking for is core cash flows. Depreciation and amortization is non-cash, and taxes and interest are dealt separately with, because the interest goes with the debt and how the debt is handled, right? And tax structures vary depending on the transaction, legal entity structure, all that stuff, right? It's not that the burden is not gonna be there, it's gonna be a different burden to the buyer and the seller, right? And what we're trying to do is come up with common language, so we can say, okay, this business on a core EBITDA basis generates $200,000 a year. Like, what is that number that we can say, this is the core cash flow generation of the business, right? Okay? Before Uncle Sam gets paid, before the debts get paid, and of course, we get rid of depreciation, amortization is non-cash, right? Okay, that's a great question. Any other question online?
Not right now.
Okay. Next page. All right, so I'm gonna ask you guys, we're gonna do a little exercise, right? This is Sunset Ceramics, it's a small pottery barn, pottery business, right? And we're gonna give you all the financial information, and I'm gonna ask each one of you to work independently on this exercise and try to come up with their EBITDA. All right? Sales revenue of 500, cost of goods 200, operating expenses, interest payments. Okay? Too much? Need help? Should we do it together? What do you think?
Let's do it together.
Do it together? Okay, so the first thing you need to calculate is net earnings, right? We know that EBITDA starts with earnings before interest, tax, depreciation, amortization, right? So what is the net earnings of that business? The net earnings of that business can be calculated by taking the sales minus the cost of goods sold minus the operating expenses, right? So what is that? 150. Someone keep track of it. Actually, I think it's in the next page, right?
Yes. You want us to go to the next?
Yeah, it is, check.
Yes, there we
Here
go.
we go. 500 minus the cost of goods sold, that's your gross profit. 300, gross profit before operating expenses, right? Everyone with me right now so far, right? Okay, next page. Then, out of the gross profit, you gotta back out the OpEx, right? Next page. It's the OpEx, operating expenses, right? And now you get to your operating income of 150, right? So before we mess with the other definition of EBITDA, we know that this business has a profitability of what percent? What's the margin of this business? 150,000 divided by the top line, which was the 2 million, right?
Can't remember what the number was.
Was it 2 million?
500,000.
All right, so what's the calculator? 150 divided by 500 is what?
30%.
No, 30%, 33%.
So off the bat, me as an investment banker will tell you, I like this deal already. 30% margin business, guy's getting 30 cents in his pocket for every dollar he brings in, right? How many of you have a higher than a 30% margin business right now?
30% margin?
Yeah,
Oh,
this
wow.
business.
That would be amazing.
That, you know, right? So that is gonna command a higher multiple.
The salary that you're taking is really throwing it off.
100%, because what happened with small business owners is that they wire their business for lifestyle, not for valuation and growth, right? So they pay to sell a lot of money and don't invest in the business to grow it. And that is not that smart, because
Yeah.
if you were to get yourself less money, but invest in your business, then you have an asset that creates value, and then you can sell it and get way more money than you were getting to begin with, so. Okay, so,
Can we go back for just a second to
The question.
the question? We just had a follow-up question from online, which was just, why is the company only making 120,
150.
100, the 100?
Yeah, yeah, instead of, they don't understand why we add that.
Yeah, add
Yeah.
it together.
Why are we adding it and not taking it out of the value?
Yeah, the
Okay.
question is really the company is only 120,000, right? And the interest, income, and depreciation all goes against the earning. So I cannot really understand why this would be an advantage for the buyer, because the buyer need to pay off interest, pay off income, pay off depreciation, but will receive earnings. So I don't really get it. Why you would use plus here instead of minus?
Yeah, because net earnings is the bottom line, and you basically what you're trying to say, if I had to convert that bottom line net income to cash basis net income, I have to add back the charge that I took for depreciation and amortization, right? So that increased the EBITDA. And then if I had to add back whatever I pay for interest and taxes, just to reflect the core cash flow generation of the business. It doesn't mean that the business is not gonna get burdened. It means that interest is gonna get handled differently by the buyer and seller, depending on whatever leverage is put in the deal and the transaction, right? And taxes for sure will be completely different depending on what type of legal entity and structures exist, right? So all the buyer, if I'm a buyer looking at your company, I really want to understand what your core cash flow generating capacity is in the future, and that's your core, that's your core.
Is the assumption that any interest, the seller's gonna take that with them, they're gonna pay off that debt.
Or they're gonna negotiate it at closing.
Negotiate
Yeah,
that
they're
out,
gonna
right?
negotiate at closing. I
Yeah.
said, look, you have 50,000 in credit card, you got 100,000 in an EIDL loan, an SBA loan, right?
Yeah.
I'm gonna give you $2 million for your
Right.
business, but you gotta pay that off before closing, right? It's a different discussion, or it could be, in some cases, some of those loans, get paid off, or assumed by the buyer, right? Like SBA loans, the EIDL is a perfect example of that. That was a 3% loan, commercial loan amortized over 30 years. It's gold. You're not gonna see that credit in our lifetime, right? We're all gonna die before you get to see a 30-year commercial loan unsecured for a 3%, right? So a buyer looks at that and said, I'm not paying down that loan. I wanna use my cash somewhere else. We'll keep you that one, right? So you know what I'm saying? Okay? Okay, next page. So we got to gross profit, to operating income, 150, and now we need to do the add backs, right? Operating income of 150 plus interest of 20 plus income of tax expense of 30, depreciation of this equal EBITDA of 215, right? So your homework is to get the EBITDA for your business, and if you cannot figure out the EBITDA for your business, you should call me and I'll help you through it. But you all need to understand what is your EBITDA for your business. You should understand what your EBITDA for your business was for the last 3 years and what you think the EBITDA for your business will be next year, right? EBITDA trends tell a story, right? EBITDA margins tell a story. You might be having an increase in EBITDA number, but your margins may be declining, which suggests you have a profitability issue. You're not pricing right, or you're selling something that is not making as much money, right? Or there's been a shift in business, in your business model. I used to sell, donuts and ice creams. I was making more money in donuts and ice creams, but all of a sudden, the customer wanted more ice cream, so I started selling those. So that's gonna impact your margin, because now you're selling a lower margin product, right? You have to understand your business trends. And regretfully, a lot of small business owners, A, are reactive, and B, do not spend enough time in financial analysis, right? And to me, that is what will enable you to be to make smart business decisions for the future.
So how many years, so let's say you're planning 4 years out, 5 years out to sell your business. When do you calculate in the current year, you go back 3 years? How do you
The buyer likes to look at history as a data point, but they're gonna be pressure and stress testing the projections, right? So when we are getting a company dressed up for sale, clients come to us and say, I gotta get rid of this in 3 years, right? Then we start managing to that EBITDA number, right? So it shows the right EBITDA in future years. A lot of it gets managed through expense management, right? If you were thinking of hiring 5 people and your revenue is trending in line with expectations, maybe you hire 4 people, right? So you increase your EBITDA, right? If your revenue is growing really fast, then you can have a little bit more, but you also want to keep an eye on where your EBITDA is going, because when you show that EBITDA to a prospective buyer, you want to see a nice, healthy trend of EBITDA coming in every year, right? Preferably with increasing margins, which is very hard to do, but above all, stable cash flow generation. That's what they're buying. They're buying future cash flows, okay? All right?
Sorry, I have so then what's like a good EBITDA number? Like, is that good?
Well, EBITDA can be evaluated in 2 dimensions, the dollar value and the margin, right? I tend to focus on your margin, right? The lower your EBITDA margin, in this company particularly had 30% margin, right? But if that would have been 3%, right? That means that for every dollar you're selling, you're taking home about 3 cents, right? That's very thin. That is not a very healthy company that could go into cash flow issues very quickly, right? So a company like that would probably have very low valuation, right? So you gotta, there are known ways to grow a business. You have to have the right strategy, the right capital base, and the right people executing against that strategy, right? And there are many ways to go about it, but step number 1 is understanding your current situation, really understanding the current situation. Where you are that you shouldn't be? Where should you be that you're not? Am I pricing this the right way? Am I spending enough marketing dollars? Am I spending frivolously, or am I helping with expense controls? Am I overpaying me, or am I not overpaying me, right? That type of stuff. Yeah.
So if 2 or 3% margins are bad and 30% margins are fantastic.
Yeah.
I mean, obviously margins will change according to sector,
Yeah.
industry, and so forth. Can you give me what an average?
Yeah,
general
great question,
ballpark
great question. I would say most businesses that I would consider to be healthy are in that 15 to 22% range, right? I think north of 25, 30s, 40s, those are very well-run businesses with a really good business model, right?
How do you calculate if you're over or underpaying
Yourself?
Yeah.
Plenty of market data. There's plenty of HR firms that will do that for free for you. So based on the size of your revenue, your business, how big are you, the complexity of your operation, this is how much you should be paying yourself, right? There's plenty of market data. I would say, generally speaking, the CEO of a company, under $1 million should never walk away with more than 10 or 15% in the top line, right? Because you want to invest in that business. You can't grow it or build foundational infrastructure without investing in that, right? If you choose to take that money and go buy it at, Lululemon, then you're not going to have the right infrastructure of the businesses, right? So, okay, next page. So in this case, EBITDA was 215,000. This business, which had a 30% margin, were probably closer to 5 times, right? So this is $1 million business that the seller could be, he could be training for, right?
I'm sorry, how did you get the 5 times?
I'm just generally speaking saying, assuming it's a pottery business, they don't have, and there's not a lot of capital intensity, so I think it's a 5 multiple type of business. If I were to research it and do the model, 4 to 5, multiply the multiple times that number, and that's 800 to $1 million, right? So, okay. All right, next page. Okay, these are other areas that affect valuation, right? And this is more lecture-y than I would have liked, but I'll give you some examples, right? If you have concentration on risk, it could impact your valuation. The sector concentration. We have a client that has $8 million in revenues, and they did really well. 90% of their business was marketing for real estate companies, right? When the interest rate environment began to rise, the real estate industry stopped, particularly commercial real estate. So what did they stop? They stopped the marketing dollars they were sending our client, right? So they went from 7 million to like 2 million in 3 years. They lost 5 million, we had to let go half the people, restructure the company, right? They were too concentrated in the real estate sector, right? What they're doing now, they're doing tourism, real estate, government, they have much more, same product, they're just selling it to different sectors, right? Geographic concentration, dangerous, right? If you were operating, in an area that is subject to a natural disaster, for example, obviously that's a high risk to your business, right? So I always try to tell people, particularly through e-commerce, to diversify your business. If what you sell, you can sell online on top of bricks and mortar, that will provide revenue diversification, right? If you are single state, single location, and there's something massive that happens there, for example, the Lawrence fires or nor'easter, so that you will feel it, right? Now, good news is that a lot of commercial insurance carriers offer business continuity coverage, right? So if you are highly concentrated in a given geography, you should consider business continuity insurance coverage, because when you get shut down, you get a little bit of relief, okay? Customer concentration, I see it all the time. We had a client that they're doing long hauls, 18-wheelers from East Coast to West Coast, 50 people operation, about 25 million in revenue. And they went from 12 to 25 million in like 2 years on the heels of landing a big contract with Amazon. They were doing deliveries for Amazon, right? 2 years went by, they grew the company, they hire a lot of people, they make a lot of money. And 6 months ago, they got a call from Amazon that they're out, that they're gonna switch providers, right? So when you have high degree of concentration in a single customer, you need to protect yourself against that. Best way, most small businesses have a lot of customers, very diversified, so that's often not the case, yeah.
Example, I own a science fiction bookstore / game store.
Yeah,
The dot-com boom
yeah,
was very, very good to me.
yeah,
The dot-com bust,
yeah, it was the other way.
literally a
Hurt.
quarter of my customers went out of work.
Yeah,
Lost their jobs and had to move to another
Yeah.
industry entirely. They stopped being programmers.
yeah,
And that was a blow.
yeah,
2001 sucked.
yeah.
Okay, I just gotta say.
So concentration, generally speaking, is not, what you just alluded to was actually product concentration, right? You were very tech dependent.
Well, both.
Yeah, that's exactly.
Both, really.
Product and customer.
Yeah, so concentration is, you just need to be aware of it, manage against it, right? And try to put some risk mitigation in place, right? That's it. Any questions on risk concentration?
What size concentration in this case?
I say, this is a great question. I don't get worried about anything under, 20, 30%. I mean, if your largest client is 30% of your revenue, yeah, if that lead, it will hurt, but if your largest client is 80% of your business, you basically become a fully owned department. You're the department of that company, right?
We had that here in Cambridge, y'all
It-
remember, the Phil's Towing? There was a company here in Cambridge, the city of Cambridge was their only client.
Yeah,
When we got rid of towing cars, we just ticket now, they went out of business.
yeah, that's a perfect example, perfect example.
They went out of business because the cities, was their only client,
Yeah,
Because it was probably so big.
and for so long,
yeah,
and
and
for
it's,
so long.
and it's comfortable. They were getting good pricing, everyone was making money, it was one relationship to
They
manage.
never thought it would end.
Complacency is a killer in business management.
Very
You
much.
can never be complacent. Okay, next page. This is another concept in business continuity that is really important, right? The businesses that create or carry the higher valuations are businesses that have repeatable processes, which are not dependent on the principal. Remember, they're buying an operation that they can assume that without you will continue to run smoothly, right? If not, they're gonna have to hire a CEO and replace your salary with that CEO, right? And that's gonna not help the margin as much as they would have liked, right? It's a hard thing to do, right? But as you think about investments in your business, always think about how can this process work without it being so critically dependent on me, okay? If you're closing the books yourself, maybe you should have a bookkeeper that does that for you, right? If you are running the marketing yourself, maybe you should outsource a little bit of the digital marketing, right? If you find yourself knee deep in operational issues, maybe you should have an operations manager, right? Again, all this stuff, it's adding expenses, but it's also adding repeatable processes that when it's time to sell, right? The buyer's gonna see, this business is running, I don't need to put a lot more money, it's running, and when it's running effectively without the seller, right? When problems happen for the buyer is when they give you a check, you say bye-bye, and then the buyer looks at this and things begin to fall apart, collapse, right? Most buyers are smart enough to do something that's called due diligence to assess the operating foundation of the acquired enterprise, okay? So diligence is a topic for another day, of the deal process, right? Most deals take 6 months to consume, from a letter of interest to a definitive agreement, to diligence and closing, and the legalese that comes without it, right? But there is a very, very clear science around how to close a business, how to actually close a transaction, okay? Okay? And by the way, if anyone here or online is actively looking to sell a business, we'll be happy to talk to you about it, you know, and that's just kind of like where you are in your journey, maybe the things that you need to think about. Okay? Technologies, right? So we're talking about, hey, maybe you have to put all these expenses in to stabilize the infrastructure. How am I going to be able to afford that? Well, there's no better news in the world of business than revenue growth, right? And growth attracts capital. If you have a buyer that sees your top line growing, that is going to command multiple expansion, what's called multiple expansion in your EBITDA multiple, right? Because they see that you can grow that business, right? How do you grow that top line, right? And these are just a few examples, right? E-commerce platforms, marketing, you got to step up your marketing activities, right? Brand awareness, how do you understand and get to your target customer? You got to understand your value proposition, your unique value proposition. What is it that you're selling that is unique to you, that will make the client go, I need this, right? Right? The more you can differentiate your value, the higher it would be to come up with a credible investment thesis for someone to acquire your firm, right? The more you cannot differentiate your value, right? If you sell nails and you're competing against someone selling nails, it's called a commodity, right? Or you sell gasoline, you compete with someone selling gasoline, that's a commodity. It's very hard to differentiate that, right? Lower valuation businesses. Okay. By the way, you can have lower valuation businesses that generate cash flow, okay, right? Some businesses are acquired because they generate steady cash flow, not because of growth or because, yeah. Okay. CRM systems. This is once you have a sales-minded mentality, it's called client relationship management. It helps you with organize your prospects, who you're talking to, what stage of the deal process I am in terms of revenue generation. Where are they? If I need to send them Christmas cards or holiday cards, they're on a list, right? So if you are in a business that has clients and prospects, you should have a CRM system, okay, to keep yourself organized. Okay? And then this is a very useful tool that you're gonna need no matter where you go in life, in your business, right? Whether you're doing a new loan with a bank or a refinancing with a bank, or you're trying to sell your business or buying a business, people need to clearly know what is your debt position. And this is a very standard debt schedule that says, look, this is who I borrowed money from, what type of money, the number, the amount, the interest rate, the terms, the 5 years, 10 years, start date, end date, how much I paid today in minimum balance. And you need to know that and have that readily available because it's a key element of information for any type of capital market activity, whether it's a buy or sell or refinancing or lending, right? Okay. It's mind-boggling to me sometimes that I go to clients and say, show me your debt schedule. They're like, what is that? I say, well, show me your balance sheet. And then I found out some of these loans are not even in the balance sheet. It's like if you owe money, you need to own up to it because someone else knows that you owe money. They'll find you, right? So All right, and you can owe money to the government for back due taxes, you can owe government to regulators, the IRS, the Department of Revenue. If you owe money, lay it out, so it's no surprises when it comes to valuation of the firm. Okay? All right, next one. This speaks to, I was alluding to earlier, the best way of designing your own business strategy is starting with an honest assessment of where you are, right? Your strengths, your weaknesses, your opportunities and threats. It's called a SWOT analysis, right? And then out of that comes a strategy. I have to invest in here, I have to disinvest in here, I have to hire this person, I have to fire this person, right? And then you come up with measurement systems to make sure you're trending against the execution of those milestones, right? Growing a business is hard, but there is a science behind it. There is a science behind it. If it was easy, everyone would be gazillionaires, right? It's hard, but there is a method behind it, right? And one of the most important things that you can do in your business is understanding who is doing it better than you and why, right? If you sell consumer goods in a retail shop, go find out the retail shop that does the most. Wow, what are they doing better than me? That is going to be manifesting that SWOT analysis, right? Okay. The other thing that people usually go through this to give themselves conviction, right? Because I always tell people, don't be afraid of borrowing money or taking equity, right? Someone else invests in you. But do so once you have a highly convicted business plan, right? So you go through this and you said, oh, I understand where I am, I understand where I need, I understand where I'm going. You need to know where you're going. If you don't have a destination, you're just wandering, right? And then you say, if I were to make this play 1, play 2, play 3, maybe I put this technology here, or I open a new store here, or I hire this critical resource. It's gonna cost me $500,000. Go to the bank and get the $500,000, right? You gotta have conviction in your investment thesis. I wouldn't do it without robust stress testing, robust advice and analytics behind it. But once you get that conviction, then you should go ahead and put capital in your business and grow it, right? Doesn't come without risk, but you will never gonna hit a double or a triple or home run if you don't take the at bat. Okay? Okay, next page. This is some of the stuff that could happen in the future that will impact the valuation in your business, right? The first two are quite common to me, like market conditions. Right now, the number one market issue is interest rates, right? Borrowing costs are higher than they've been in 30 or 40 years. And with inflation still crunching up a little bit, everyone thought that interest rates were going to start coming down before the end of the year, and it appears that they are not going to start coming down. It's going to be high for longer, right? So that is going to create cost pressure in your business, right? You have employees, wage pressure continues to creep up, right? Because they need to make more money to pay for the goods that are now higher than they were last year, right? The more you pay your employees, the more margin pressure you get yourself. So you're gonna have to reprice the top line, and it's like a vicious circle of inflation and inflation and inflation. The Fed keeps interest rates high because that's like putting a little bit of a brake on the economy. The higher the interest rates, the less cash is going to be flowing around. People take less loans, or construction loans. They're not awarded. Like the banks say, nah, your margin is too thin, so I'm not going to lend you this money, Mr. Developer. All that economic incentive to slow down the economy eventually would result in like a recessionary pressure. We haven't seen a recessionary pressure. We're hoping and still hoping to get a soft landing. But until you have that contraction happen, it'd be hard to slow down inflation. So inflation has decelerated, but not to the level that it makes the Federal Reserve feels comfortable about reducing interest rates. I actually have the privilege of meeting with Susan Collins, which is the chairman of the Boston Federal Reserve, tomorrow on this topic, here and a few others. Okay, and that's it. You gotta know technology, what's happening, right? You know, if you were the #1 producer of CDs in 2001, that business disappeared once digital music became about, right? So you gotta be aware of what's changing, right? If you had 20 medallions for a taxi cab, right, that were worth $500,000, guess what? Now they're 100,000 each, because the advent of ride sharing has completely destroyed the value of the medallions, right? And that's it. It's like competition is always there. I always know what your competitor is up to. If you spend 90% of your business, of your time inside your business, that's usually not good. You need to be outside of your business to be able to look at what's happening, right? Go to trade shows, go to competitors, go to trade shows, yeah. Worst thing you can do for your business is being on the business 100% and not going outside to get a fresh perspective, okay?
Do
Next
you
page.
think, JC, this is a good place for a break?
Yeah,
Yes?
do we need a break?
5
minutes?
5 minutes, good?
All right. What do we have next?
Oh, yeah, I'm sorry.
Okay, contract. The most typical error there, tend to be around, leases, right? Whether it's a car lease that you put in the business, or a, office space lease that you put in the business, or a photocopier machine lease, right? When you sign a long-term contract, one of the first questions that you need to ask is whether that contract is assignable, right? Because if all of a sudden you sell the business, but the contract is not assignable, guess where the liability is gonna go to? You, not the seller, not the buyer, right? Most contracts are assignable, right? But you gotta make sure you sign a contract that is assignable, otherwise doesn't put you at a disadvantage if you're trying to sell your company, right? Generally speaking, I always tell folks that they're thinking of listing their property or selling their company, try to minimize long contract duration, right? Because, for example, if you have company A, and company B is acquiring you, and company A happens to be in downtown Cambridge, right? But company B happens to have a store in downtown Cambridge, guess what? They're probably gonna shut you down and move your employees to their store and consolidate, and there goes the problem with the lease, right? So, be very careful with your contracts, always have an attorney review the more complex ones, right? There's a reason why attorneys exist, right? And there's wording that could be added, that could protect, the seller, okay? Other contracts that I can think of are contract with, on the top line, with distributors or revenue providers. For example, if your largest customer, you know, sends you $200,000-$300,000 of revenue a year, you wanna try to get that as close to recurring revenue as possible, right? That revenue stream, if you sign a multiple-year contract, right? Remember the Amazon guy, the Amazon example? He had a 10-year deal with Amazon, right? The longer the duration of that revenue is recurring revenue, the higher the multiple will be, right? Because it's steady. The buyer doesn't have to worry that revenue is gonna be there next year now. You already have a contract for it, right? So longer duration revenue contracts, generally speaking, work better in a buy transaction, in a sell transaction, okay? Whereas if you have 1 month contract, 2 month contract, that's not particularly recurring, right? Okay? Yeah. By the way, contracts could also be contracts with employees, right? If you tell your employees that you're gonna give them a profit share or a bonus or whatever, all that stuff affects the valuation of the firm, right? So be very careful when you're thinking of selling your company. What are you legally binding the company to? Okay? All right. When we talk about recurring revenue, my favorite term, right? The most important term in the deal business is EBITDA. My favorite one is recurring revenue, right? Because recurring revenue is think of Netflix, subscription-based revenue, it just keeps coming and the cost of sales is not nearly as high, right? In here, if you have a guy that mows your lawn or a cleaning lady that cleans your house, which is an example, that's recurring revenue to them. They know that they don't have to call you every year, every month, say, hey, do I need to clean your house or I need to mow your lawn? No, that's recurring revenue to them, right? Some of the businesses that have been sold, that have the highest multiples are not particularly fancy or sexy. They are just recurring revenue businesses. The revenue comes, right? Why do you think supermarkets and liquor stores, very, very low margin, but they have good multiples? Why? Because everyone needs gas for the car and everyone needs to eat, right? Recession or no recession, right? It's recurring business, capital light, okay? One-time revenue, yeah, so interesting, everyone likes the one-time revenue, right? An example of that could be when Masgrove Capital was issuing grants. I don't know if some of you got grants, or when we got PPP forgiveness in the pandemic, right? That is one-time revenue. It helped balance sheets, it helped businesses weather the storm, right? In a valuation scenario, it means nothing. It's not recurring, it's not operating. What the buyer is buying is future cash flow, not past cash flows, right? So yeah, we all like it, keep taking them, keep getting them, but it won't impact the value of your business, right? Unless you take that one-time revenue and put it to work in the business. Oh, I need to invest in here, I need to invest in that, right? Yeah, so when it comes to the total value of the firm, ultimately, no matter how many spreadsheets you do, your financial advisor is almost like Surfside Capital is gonna say, we've done these 5 methods, we've done the assessment, we think this is a strategy, and we think your business is worth $2 million, right? No matter what that estimate is, and by the way, we typically do value ranges, we never put a point estimate, we said it was worth between $2 and $2.5 million, right? The buyer is looking for certain things, right? The value of the business will base or change depending on the buyer, right? If this is a critical market or product gap that he had, they're willing to pay a little bit more, right? If they are after you as a leader and they want you to be part of the deal, meaning we're gonna buy your company, but we're also gonna give you another $1 million to stay employed with us for 5 years, right? If they're in love with the talent, they'll pay more, right? Not just the products and the margin, but the people running them. Finding good people to run business is hard, right? So buyers are willing to pay up for good people, right? The balance sheet, we talk about the balance sheet. The balance sheet is, if it's a poor balance sheet, right, it's gonna command a lower valuation. It's a healthy balance sheet with good receivables, good AR, you know, some debt, but not too much debt, that's gonna get a good multiple, okay? And then lastly, which is not here, structure. Valuation and structure, deal valuation or deal structure are very different things, right? Example, if I tell your business is worth $1 million and you tell me, JC, I think my business is worth $1.4 million, right? What often happens is there is a negotiation in the structure piece. So the buyer says, guess what? I'll give you 1.4, but I'll give you 1.4 if you finance $1 million for me, meaning I give you $400,000 at closing, and then you give me 100,000, or give you 100,000 over the next 10 years, right? If you provide seller financing, you're gonna get more value, right? Because that buyer is not gonna have to go to the bank. Basically said, look, I'm gonna get a richer value. I am going to finance your transaction, right? And I'm also taking the risk that, you know, that the loan goes bad, right? Because what happens is you put your shares in collateral, right? And then you release them from collateral as your note gets paid, right? But the point here is that typically you can get your value aspiration if you have structural leverage. If you can provide seller financing, you know, another one that I've seen in the deal that we're doing right now is an asset management firm that has 500 million assets and about 5 million in revenue, and the buyer, which is a big Fidelity-like person, saying, we I'm gonna give you a valuation of 10 million, we're gonna give you 6 million at closing, but 4 million after you stay for 3 years with us, because we gotta transition all these accounts to our platform. If at the end of year 3, you did better than the projections that you told us today, we'll give you more money. If at the end of year 3, you did lower than the projection, we'll get a haircut. Right, so that's called contingent consideration, right? So there are many ways to bridge the gap between the bid-ask spread. There's gonna be every deal that I've been part to, the buyer and the seller are never gonna be in the same starting point. The buyer wants here and the seller wants here, and then you have people like us that help get them together. Okay? Okay? What else? Is that it?
No, it's coming, but it's.
Any questions from our Zoom participants or here? I know that the Celtics are playing tonight. I'm aware. I'm going.
I was a little bit surprised that you were advocating for short-term leases. I mean, I think that, like, for, like.
I don't know, I'm looking for short term lease. Yeah, well, you want to go long, right, particularly now in the market, because the commercial real estate market is so suppressed that the per square footage are collapsing, right? You go long when the market corrects and short when the market is rising, right? So I wasn't advocating for short or long, I was saying when you're selling your company, you have to be very careful in what contract you enter into, right? In the analysis piece of it.
So if you're in a lease now that you negotiated, say, 5 years ago for 10, 15 years, you might have got a better deal then.
When does your lease renew?
That's part of that.
Lease renewals are across the board, people are renting at lower price points because there's so much excess
'Cause there's so
capacity.
much
Yeah,
capacity,
so I'm
yeah.
like, you know, but they say hindsight is 20/20. I would have thought that a long lease after COVID was the right thing to do.
Yeah,
The reality is, it was
It
probably, it
wasn't.
wasn't, right?
Yeah.
So
yeah.
right now, what we're telling our clients are, these are steady clients, not buy sell company, right?
Mhm.
It's like, go long.
Mm.
Go long, because if you look at values in Boston commercial real estate over 50 years, this correction is real, right? It is real, right? So not the same on residential space. In residential, actually the complete opposite happening, right? So this is just for commercial office space in particular in downtown areas, yeah. Okay, what else?
Activity time.
Okay, financials, yeah, your most reservations, yeah. So do they have their own tax returns or is that?
No,
Yeah,
we have a sample tax return.
so all of you personally do tax returns, right?
No,
Okay, so
CPA.
I know, but what do? You do a subchapter S or you do a Schedule C or S corp, right? So the first thing you do is understand your tax legal entity. There's a difference between a subchapter S, LLC, and an S corp and a C corp. Or some folks don't even have a legal entity for their business, they just go right to Schedule C in their personal tax return, right? Be that as it may, these data fields that we're alluding to here, you could probably, you'll find them anywhere, right?
This is the toolkit that accompanies this workshop. I'm just realizing, I don't think the tax return is actually in a big. We all have a tax return to work off of, so we can all do it together, and I didn't realize that it's not printed very big.
Yeah, this is not even for a S corp and a C corp, this is for, I see it right here, this is for a Schedule C.
Yeah.
So this is for a business that is small enough that you have it on your personal tax returns, right?
And for the.
By the way, does anyone know, a little trick side question? You, everyone know when is the right time to go from Schedule C to S corp?
I'm very curious about.
The magic number is about $50,000. Once you have net income of $50,000, you should move to S corp because there will be some tax savings associated with self-employment taxes versus payroll taxes, right? You should put yourself in as a W-2 as opposed to take care of distributions. And you'll pay less in payroll taxes than you would in self-employment taxes, right? So a lot of small businesses I've seen that started as a Schedule C, right? And they grew to make $100,000 to $200,000 a year. They're, why are you not as an S corp right now, you're paying an extra 10 grand in taxes in here, right? So,
Huh.
so
Um,
that was a freebie.
I'm sorry.
Plus you're
we're
an
lost.
employee of your SC work too, so it helps.
Yeah, it helps with benefit. You become a W-2 employee, it creates some distance between your personal and,
That's what I did.
and business assets.
Yeah.
There's a ton of benefits, right? The downside to it is that you have to file with the State Department a report every year. $500 filing fee, right? You have to, but there are two legal, you become different than the company, right? Okay, so for this exercise, we already sort of did it, is what it was intended to do is for you to be able to calculate EBITDA based on the tax return. So if you grab your tax return, right? And you come up with these fields, you go and you take your net income, you add back your taxes into the regeneration, and voila, there's your EBITDA, right? What is your EBITDA and what is your multiple? EBITDA is easy to calculate, multiple is a lot
The
harder.
multiple's throwing me, cause
Well, there's there's a lot of factors, right? But what type of business do you have?
it's a bakery.
A bakery, right?
Bakery cafe, yeah.
Yeah, so I guarantee you, if you go through some of the public companies that are in that space, Starbucks, right?
Yeah.
You can find out what type of multiples they're getting, right? And there's a lot of public information on what drives that multiple decision, right?
I found, New York, NYU, the Stern School, I
Yeah.
think, of business, they release a multiple list every year. So I'm gonna include that in
Oh,
the
that's
toolkit
interesting.
Yeah.
by industry, yeah, and I looked up apparel, just because you mentioned it. It's like 20.
Well,
Wow.
yeah, that might be wholesale apparel. You have to be careful with the definition, right? You know,
20,000.
no, 20 times.
20, the
20
multiple was like
times whatever your
19.8 or something like that, yeah.
Yeah,
So I
well,
don't, again.
that doesn't sound right.
That's,
No. That's like biotech multiple.
yeah, so